Ladies and gentlemen, I'm going to introduce our first speaker of the afternoon. He's going to be talking about how to connect blockchain and payments. Please welcome to the stage, Stefan George.
Yeah, thank you for the warm welcome. I'm Stefan George, co-founder of Gnosis, and today I will talk about payments. And that is not my screen. No, it's not my screen. It is not my computer. Okay, great, awesome. So why do I want to talk about payments? Well, payments actually was the original use case for blockchain. Now, if you think about when Satoshi Nakamoto wrote the Bitcoin white paper, he described it as a peer-to-peer electronic cash system. And we all know that the kind of famous first actual real transaction on Bitcoin was a purchase transaction buying a pizza with Bitcoin. It turned out to be a very expensive transaction, but today, actually, if you think about who's actually paying crypto for buying anything, no one does. So somehow, even though the original idea was to actually build an alternative payment system, this never actually happened. And today I want to reflect on why and why I think it's about to change. So if you want to actually tap into payments, you're facing a lot of different challenges. And for a long time, I think the number one challenge was simply scalability. Yeah, even today, if you would like to run something like Visa or MasterCard on the blockchain, you are facing insane scalability issues. I mean, we all know Ethereum itself is running at capacity for the last couple of years. And it's not going to change. There's no perspective on this actually increasing in terms of number of computational space. So the idea is, okay, we kind of move it to layer 2s. Bitcoin is trying to do kind of something in the same direction with Lightning, but even those face scalability issues. So Bitcoin, if you ask Bitcoin people how do you use Bitcoin for payments, they will always refer to the Lightning Network. But in fact, you can do a very simple napkin calculation. If you try to actually open a payment channel for every person on this planet, just once and close it after 80 years, it would never be possible to actually do this for everyone on this planet. So it's just the capacity of Bitcoin would never be able to even onboard a tiny fraction of the humanity to Bitcoin in order to use Lightning. In Ethereum, we are propagating layer 2s. But in fact, also layer 2s are facing quite severe limitations. Can look at what are the transaction costs that we're actually paying right now, and well, transaction cost for Bitcoin and Ethereum, they're both very high. So, and this is important also for the layer 2 narrative, because ultimately, we're looking at here, right now we see, the fees on layer 2s are significantly lower compared to Ethereum for swapping tokens or sending Ether, but they're still tied to the layer 1 blockchain. So any transaction that you do on the layer 2 on Ethereum, ultimately, data availability has to be on-chain on the layer 1. And on the layer 1, again, we are coming back to the same scalability issue as described before, where, well, you have to pay for transaction costs on the layer 1. And even if we are introducing changes like the upcoming EIP 4844, proto-dank sharding, we can kind of decrease those costs, but still there are significant costs. And if you think about payments, and if you do think about buying a coffee or doing smaller transfers, then any kind of fee that you add to these transactions are very significant and will make those networks not viable for the use case of simple payments. I can give another example, just to show the limitations of our current systems. Yeah? In Ethereum, we have this very popular application, ENS names. And well, let's assume 10% of the world population would actually like to have an ENS name. So we would have about 800 million names. Then if you would run Ethereum at full capacity, it would take 2 years of the full capacity of Ethereum to even process these transactions to have those names registered. I'm not talking about kind of topping up renewal fees and so on, just simply registering those. And so, we are facing still very significant issues. Another problem with payments is Volatility of fees. Right now, every blockchain is operating using a fee market. So if they basically have a constant demand of blockchain space, and there is a volatile demand hitting this constant supply, and that leads to volatility in the price of those fees. Now, that's something that also doesn't really work for payments. You don't want to pay more for your coffee if a lot of people at the same time want to buy a coffee, just because the network runs at capacity. So all of those constraints just don't really make sense in the context of payments. Another big issue is simply regulation. For you, in order to do payments, obviously you need to use some tokens that you can easily relate to. So the reason why US dollar and euros are used for payments is because you can easily associate what is the value of what you're actually paying for. And well, we have a history of different stablecoins being issued. One of the first was actually Tether since 2014. It's even today the most dominant. Then we had DAI being started to be issued in 2015. 2018 USDC came into existence, then Binance USD followed, and then we had a lot of experiments like UST trying to innovate in the space. And yes, it turned out that even the more conservative ones like USDC were not as stable as we expected. And there's generally still like some mistrust by consumers, but also institutions and other parties that are relevant for payments in order like if those are actually sufficient for us to be used in the context of payments. Obviously, there's a lot of regulatory scrutiny, and yeah, we need to innovate on this level also in order to actually make payments a thing. Other big issue, self-custody. Well, obviously, like I think in order to onboard a lot of users to crypto, the current way of onboarding users to wallets is not the way to go. Account abstraction is a big topic. There's some people from Safe here. You should talk to them. We're working on solutions for account abstraction. There are solutions, but de facto today, most users are not using them, and we don't have any clear like path for wallets right now, or like any wallet I would actually say is ready for mass market adoption. The other issue is that if you look at payments, they're kind of solved. Obviously, we all do payments, and if you kind of compare like how many blockchain transactions do you actually do on a daily basis versus how many times do you swipe your card to pay for something, it's very obvious like we all do a lot more payment transactions than blockchain transactions. That's also simply because the UX of payments is actually very good. Like it's very convenient to pay, and it's really hard for us to create something that can be on par or potentially even better. The other issue is, obviously, for payments, this is kind of a two-sided marketplace. You have on the one hand, you have clients that want to pay. On the other hand, you have merchants that have to accept payments. And well, right now, the amount of merchants that are actually willing to accept crypto is very small. And we have to find a way to kind of tackle this problem to not have to grow the merchant base at the same time as the customer base in order to make it successful. So why do we still think we should talk about this and try to solve it? Because there's also a massive opportunity. Because payment as they are done today also face many issues. If you look at payments today, then we can see two things. One is the front end for payments has been constantly innovated. So we started with the Diners Club cards, then the Bank of America card, and then, well, today we have like Apple Card, and like we see it constant innovation on the front-end level, and it becomes more and more convenient for users to actually interact with payments. On the other side, if we're looking at the back-end side, like what's actually happening in the background whenever you do a transaction, then we see that this became increasingly complex with an increasing amount of middlemen trying to benefit from every transaction that you're doing. So obviously, ideally, there would be a peer-to-peer transfer, or like there would be a transfer between the two parties that actually want to do the transaction, the customer and the merchant. But in fact, because there's so many parties involved in issuing and processing and acquiring, that these transactions become increasingly complex, and every of those parties will try to get their share of the transaction. So if you do a transaction today, probably about 5 to 10 parties are participating in benefiting from what you're doing and the fees that are being charged on those networks. Meaning, we're talking always about removing the middleman. This is the prime use case. Like, there's literally so many middlemen in every transaction that should eventually be eliminated. So now I talked a lot about problems. How can we actually solve this? So fortunately, there are technologies being developed by us and close parties that can help us step by step to tackle each of those problems. One very important problem is kind of related to also the stablecoin part, is the way for users to actually enter blockchain and exit from blockchain and have value represented on blockchain that they can actually relate to. And we're working together with a very cool company on this called Monerium, which offers a best-in-class on- and off-ramping. The way it works is that every user that has an account with Monerium gets actually an IBAN issued. And if they want to on-ramp, what they can do is they can simply do a bank transfer to their newly issued IBAN, and Monerium will issue euro tokens on-chain for this user at no cost. So it's an on-ramp where the user has zero cost, where with SEPA Instant you can do this on-ramp within half a minute in the best case scenario. And you have a vanilla ERC20 token on-chain that has no restrictions whatsoever for DeFi. So that's a great user experience. Important also to understand, Monerium has something called e-money license. So what is actually being issued on-chain can be considered like cash. So it's actually regulated, but in a way that still allows us all the flexibility to use this money on-chain in DeFi. The cool thing is you can also do it vice versa. You can actually also off-board very easily by doing an on-chain transaction. You're doing an on-chain transaction that will effectively burn the Euro E that you have in your account and do a SEPA transaction to any account you would like to send money to, also at no cost. So in summary, like if you are in Europe and you want to cash out, go over Monerium because you save money and time compared to any centralized exchange. To make it really straightforward, we actually built a very simple UI that allows to combine this exchange experience. So you can go from any network, from any token, directly to a bank account. And you don't have to go over any centralized exchange. You don't pay any exchange fee. And it can be done within a minute. As soon as the blockchain transaction is sent and mined, the bank transfer is triggered. This is something that's currently under development, but hopefully we can launch it around ECC. So this is kind of the on-off-ramp part for just getting tokens on-chain. Obviously, what I actually talk about is payments. So how do we solve payments? Self-custodial payments, and why it's actually a thing. So we saw like kind of last year as a prerequisite for this was the year of self-custodial wallets. Yeah, we saw a lot of centralized institutions and exchanges failing, which actually led to a massive increase in self-custodial wallets being used. Yeah, we saw like when FTX happened, we saw within 24 hours billions of dollars leaving other centralized exchanges such as Binance to self-custodial wallets. Yeah, the Safe has like all-time adoption right now. We see there's a clear trend, clear awareness. You should not trust those institutions. You should not trust centralized exchanges. You're taking an unnecessary risk compared to actually having funds in your own control. So obviously, this is kind of a very important trend for us to do the next step to allow self-custodial payments. And this is exactly what we're working on at Gnosis right now. We call it Gnosis Pay. And Gnosis Pay is the first decentralized payment network that tries to completely remove the barrier and the gap between real-world payments and blockchain as it is today. Gnosis Pay itself operates as a layer 2 on top of Gnosis Chain, which allows us to have the scalability and the feeless experience that is needed for everyone to simply do transactions as they're used to. And to make it really obvious, we're creating the first product, which is the Gnosis card, which is the first non-custodial Visa debit card. You can use this card with funds that you have directly on-chain, but you can use it anywhere where Visa is accepted. So from day one, you have 80 million merchants where you can use your crypto anywhere with the same user experience as you had it before. And also works with Apple Pay and everything else that you had before. We tried to make it a very open network, so obviously we're at the very beginning, and the launch is still to be done in like about 2 weeks' time. But we want every one of you to join this effort to build the experience about payments, non-custodial payments. And what we take care of to make sure that all the other parties from the fiat world are fine with like operating under these assumptions, meaning we make sure that all the funds which are on the decentralized payment network can actually be used in both worlds. Like they fulfill the criteria to be used in fiat, and they, of course, fulfill criteria to be used anywhere in crypto as well. And yeah, I would like to invite you to join the waitlist. You can go to gnosispay.com right now, and you can sign up to be one of the first to receive this non-custodial payment card. And then hopefully all of us will actually do a lot more on-chain transactions. And I think we can do a lot of great innovations, because I feel we have been innovating a lot in our space. We have been creating a lot of amazing DeFi tooling especially. But so far, it is only really accessible to very few people that are directly in our space. I think with these kind of innovations on the, I would say, almost user experience side, we can then make it much more accessible to everyone. And yeah, so we're going to launch in Europe, but we also prepare everything already to be also available in the United States and in many other countries on this globe. So yeah, it's an exciting journey. We will have more information at ECC in about, I think, 10, 14 days. So I hope to see you there as well. And now I'm happy to take any questions. Has someone, okay, I think you can just ask your question.
How is it possible that the ranting does not really incur any fees? I mean, it's kind of, I mean, they do have their costs, right? Like
That's right.
admin costs and whatnot, so it's very important.
So SEPA transfers are insanely cheap. It's a fraction actually of a cent. And it's kind of bizarre if you think about how much you actually have to pay as a customer or as a merchant, ultimately as a customer for every transaction, right? Like transaction cost that the customer pays about maybe, in Europe it's maybe 20 basis points. In US it's much more than this, but the actual like transfer within the bank is very, very cheap. So the way Monerium makes money right now is thanks to the increasing interest rates. The euro that you are sending to them, they are allowed within the e-money license to invest into short-term bonds. And that allows them to subsidize all the services they are offering, like the SEPA transfers and everything else. Because SEPA transfers are insanely cheap. IBANs are also relatively cheap to maintain. So these costs are pretty low. And it's just a very good example of like how much value extraction happens on top that actually is not really justified, and where just very few parties are really exploiting their monopoly. Correct. Right. Yeah, very good question. So I repeat the question. The question is, like I mentioned, the Gnosis Pay layer 2 on top of Gnosis Chain is feeless. So contrary to every other network, the user is not paying a fee to actually like do transactions. How do we prevent spamming? That was the question. So right now we're using basically like common techniques from the Web2 world to prevent spamming. And of course, we also, like users that are operating on the network, we can rate limit. And so far, we have not been facing significant issues with this. I think it's an evolution. But we see the potential to actually keep it feeless. And the question is also generally, how do we scale? I mentioned at the beginning, layer 2s are also very limited actually in how they can scale. The way how we see this progressing is that we have kind of horizontal scaling, where we have multiple layer 2s for different regions operating in parallel, because usually like payments are happening in like more regional, like you as a customer, you mostly interact with merchants in your area, so it's easier to kind of shard users across those different regions and have multiple layer 2s operating in parallel. Right, I mean, right now it's fully subsidized by us. And well, I would say the great thing is, it talked about payments, there's a lot of fees involved. So there's actually a very big pie of money that is currently made by someone else. And now we can start kind of redistributing this. I would also not foresee that Gnosis Pay will drastically decrease like cost for the end user at the beginning, or also for the merchant, but will allow us to grow the ecosystem first of all and reinvest this money in order to grow the ecosystem around the actual decentralized payment network. So again? Oh, of course, absolutely. So actually I forgot one very important point, which is every user operating on Gnosis Pay is operating via a safe account. So on Gnosis Pay also account abstraction is built in through safe accounts. So safe is actually very important for this. In the future, I mentioned right now we basically accept stable coins for payments, but in the future, of course, users will probably want to use any kind of token, which will require the processor to rebalance eventually. And I think that would be the time to probably bring CowSwap into this equation as well. So I think all of this will grow into effectively one ecosystem in the future.
And what's the size of the opportunity, if you can share? Because you said it's huge, right?
Yeah.
You didn't share any numbers.
Good question. Next to you sits someone who actually works with us who's from payments. But I mean, just the revenue that Visa and MasterCard are making is for me the opportunity size. And that's obviously in the, I don't know, 100 billions. So it's like a massive market, just in terms of revenue that they're making. Of course, the profits are way lower. But they're massive companies. And each of those has a much higher market cap than Ethereum has today. So that's basically the opportunity. Very good question. Yes. Correct. Very good question. So the question is like, what are the security assumptions of the layer 2 on top? And how do we make sure we are staying compliant? So of course we work quite conservatively, especially at the beginning. So what we did is, we took optimism. We are operating the sequencer, which allows us to have control over transaction ordering while still having a non-custodial environment. How do we make sure we are compliant? Any funds that are entering the layer 2 go through a KYT process. So you can think of the layer 2 as a trusted space where all the funds that you can have in this layer 2 are compliant to be used in the regular fiat world as well. Okay, I think I have to stop. Thank you. Thank you.